Welcome to the SRS podcast. Today, Mike will discuss rising interest rates and what they mean for you.
Today, we want to talk about interest rates, the effect on the market, and the upcoming elections. Today, the Federal Reserve said it's going to announce an increase in the Federal Reserve rate. What does that mean to you and I? It means that if you have a floating rate mortgage, if you have a home equity loan, or even credit card debt, it's going to mean that you're going to pay more to borrow that money from the banks, from the institutions that you lent the money to. When the Federal Reserve raises rates, they do it for a reason. The economy is getting stronger. It's, quote, heating up in the words of the Federal Reserve. The Federal Reserve typically doesn't raise rates just once or twice. They do it multiple times. This will be the third time this year that they've raised rates. And in past history tells us anything, they're going to do it more over the next several months. The problem is they look at this as a way to try to stop inflation. We've had some great economic news. We've heard jobs are very, very difficult to fill. Companies are having trouble hiring people. Unemployment is at a low point, and companies are paying more to get people to work for them. That's a great thing. The problem is, because you have to pay more to hire an employee and pay them a higher salary, at some point you have to pass that cost along into a consumer in the way of your goods that you manufacture. That creates inflation, and the stock market doesn't like inflation. That could be a problem down the road. It's going to affect bond portfolios. It's going to affect bond funds even more severely. So if you own bonds, or more especially if you own bond funds, be very careful. Look at what's in the portfolio. Actually read that prospectus and see how long some of those maturities go, because that fund can lose money. Bonds are supposed to be safe investments. When interest rates go up, bonds are not safe investments. They're as volatile as stocks. And speaking of volatility, the other thing that's going to create some market uncertainty here is we're going to have an election here in about 5 to 6 weeks. In November, we elect a whole new House of Representatives and probably a third of the Senate. Political change, markets don't like change, and they don't like political change. So what's going to happen in the election? Nobody knows. But it can affect the stock market as well too. And whenever there's uncertainty, the market usually takes the path of least resistance. It's called profit taking. In October, November, typically bad months for the stock market as well too. Learn about some ways where you don't have to worry about those up and down movements in the stock market. Learn about some ways where you can actually ride out those storms, never lose money in a down market, but participate significantly to the upside when the market goes up, and never give back those gains. Why wouldn't you want to do that for a portion of your money? Take a portion of your money, put it into one of these indexed annuities, these hybrid indexed annuities, which will go up when the market goes up, never go down when the market goes down. You keep your gains, you keep your principal, you only move forward, you never move backwards. Why wouldn't you want to do it? We'd like to help you. Thank you.
All of us at Secure Retirement Strategies sincerely hope that you have found this podcast informative. If you have any questions, don't hesitate to give us a call at 866-481-5211. You can also visit us on the web at srsstrategies.com. Be sure to like and subscribe to our podcast on YouTube, and you can also find this podcast in audio-only format on iTunes. Thanks.